I've been investing for over 8 years, and that's a long time, over a quarter of my life. In this video, I'll be sharing the 10 most important lessons that I've learned over the last 8 years and how I've built this £180,000 plus investment portfolio. I've gone through my journey and my mistakes in previous videos. I'll flash them up now to the side of the screen if you're interested for your perusal. What a word. I mean, I never would have used that word when I was 20, 8 years ago. I was probably in the student union having 4 VKs for a fiver. How times have changed and how my life has gone downhill. This video isn't absolutely everything I've learned, but it is the most important things I've learned, and ultimately it's what I wished I'd watched 8 years ago. Feel free to drop your most important investing lessons in the comments below, but let's get into it. You need to ignore the noise. Seriously. I've experienced a lot in my investing journey and career since 2017. The Brexit drama, COVID, wars, record high modern inflation, record high modern interest rates, tariffs. It's genuinely mental how much has happened in the last 8 years. Yet, look at the returns of the US stock market and the global stock market. Of course, past performance isn't an indicator of future returns, but there is always, in my experience, a massive disconnect between what's going on Wall Street and what's going on in Main Street, meaning what's going on in the actual world from day to day. And that is why you need to just keep investing and ignore the noise. You can't time the market. As everyone says, time in the market is better than trying to time the market. I've even made this mistake myself many years ago on my Instagram page. When COVID first happened, I remember making an Instagram graphic on Making Money Simple that said I was going to continue to dollar cost average in every single month. However, I'm not going to invest the excess cash I had on the side. And boy, was I very wrong. The market bounced back almost the quickest, I think actually the quickest it's ever bounced back from a 35% drop. And we went to new all-time highs in the market a year after that. Honestly, how wrong was I? You just can't time the market. The best days in the market often come after the worst. And as you can see here in this graphic from Visual Capitalist, if you miss just a handful of the best days, the best 30 days, and this is over a 20-year period, you massively reduce your returns. Another graphic here on screen just showing how time in the market really is simple, but also the key to building your wealth over the long term through investing in the stock market. It is worth saying that investing is a privilege. It means you're in a country with access to investment platforms and you have disposable cash that you can invest. I sometimes take that for granted myself, but the most important step genuinely is just to get started. But then once you get started, the most difficult thing is to stay invested, ignore the noise, ignore the chaos, ignore all the short-term volatility and fluctuations. As Jack Bogle said, don't do something, just stand there. And another great quote, wealth is built in the decades, not the days. And I feel like those 2 points summarize the ignore the noise, don't time the market ethos quite well. Ethos? Is that? We'll go with ethos. I don't know if that works. And if you want to learn about investing, I've got a free guide, first link in the description. You need to invest regularly. Whilst lump sum investing does perform better than cost averaging, and I also released a full podcast episode on that recently, regular investing smooths out the ups and downs over the long term. Even in 2025 alone, look how volatile the year's been for the stock market. Regardless of the price, just invest consistently. Whatever you prefer, weekly, fortnightly, monthly, quarterly, just invest at set intervals regularly. The way I try to look at it, the market's up, great, I'm wealthier on paper. The market's down, great, I can invest at lower prices. Win-win either way, and that mentally helps me get through my investing journey. Investing regularly also builds a great habit, and it means you're paying yourself first every single month, which of course is rule 1 from Rich Dad Poor Dad. Although, yeah, that guy's a bit of a doomsayer now, so yeah. Still a good principle though. I do back pay yourself first. Automation is powerful. And this was, bear with me, my number 1 tip for personal finances in stop waiting, start investing. Always good to get a shameless plug in. The bottom line is, when it comes to manually investing, you might bottle it. You might think the market's high and wait for it to come down. You might think that it's low and gonna drop lower. The bottom line is, you have no idea. I have no idea. No one knows. It's all just human psychology. And if you can just automate your investments, you'll sleep easier at night. It's less manual, it's more automatic, and it's a massive win. Automation removes your worst enemy when it comes to investing, which is ourselves. Avoid lifestyle inflation, or as some people call it, keeping up with the Kardashians, keeping up with the Joneses. What this ultimately means is increase your contributions over time as you grow in your career and your salary increases. Now, it's worth saying your investing contributions might not be linear. Life happens, you might have had a baby, you might have bought a house, you might be out of work. So it's not like your investment contributions are gonna go bang, 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 up and to the right. But generally speaking, as your career progresses, try and keep your expenses similar and invest a slice of every bonus you get, every pay rise you get, every windfall you get. That is how you don't get sucked into lifestyle inflation, can invest more, and ultimately achieve financial freedom quicker. Global index funds and ETFs are the best and easiest way to invest, in my opinion. It's boring, I know, but it works. I could bang on about this all day, so I'm not going to give you a lecture, but by using global index funds, it takes all the guesswork out of the equation, and the global fund will self-cleanse or calibrate over time as different companies, sectors, industries, and countries perform well or poorly. It's automatically reflected in the global fund. There are drawbacks. The fees for global funds are slightly higher. The returns haven't been as good recently as US funds, for example, and I mentioned it can be boring. But it keeps your approach as simple as possible, and I just love it. And most of my own money, even though I love investing and talking about it and all this stuff, is in low-cost global index funds and ETFs. I essentially have one global fund in each important investment account. As a side note, I'm also a fan of the core satellite approach, a term that's been coined more recently, where you keep the bulk of your portfolio in low-cost funds. So for me, that's low-cost global index funds and ETFs. And in a much smaller part of your portfolio, maybe 10, 20, even 30% in higher risk specific investments. Could be individual stocks, could be sector-specific ETFs. For me personally, that's crypto. So I have about 85% of my money in global funds and about 15% in crypto, mainly Bitcoin. That's a side point, but just for a bit of transparency, how I go about it with my own investments. You probably don't need to do more. This links in quite well with the previous point. I mean, you can do more, but you don't need to. You can do individual stocks. You can do US funds. You can do AI ETFs and cloud computing ETFs and electric vehicle index funds, but you don't need to. Often the more you tinker with it, the more you could get wrong. And that's from my own experience of speaking to hundreds, if not thousands of people over the years through Making Money Simple. The simplest approach is best. KISS, keep it simple, stupid. I'm not calling you stupid. Don't unsubscribe, but you know what I mean. And if you haven't subscribed yet, make sure you do. More videos coming soon. A great quote to summarize this is, complexity is the enemy of returns. Just keep it simple. Tax efficiency is key. We all pay enough taxes already, as we know. So the more you can keep in your pocket by paying less taxes, the better. Most countries have tax efficient accounts, so use those. In the UK, that's a stocks and shares ISA, where the money goes in already being taxed, but then it grows tax-free forever. No capital gains tax, no dividend tax. And pensions almost work the exact opposite. We avoid tax today and get tax relief on the way in. And a great thing with pensions is, if you're a higher rate taxpayer, for example, you could be avoiding tax at 40% today, and when you come to withdraw it down the line, only pay 20% basic rate income tax. Of course, it depends how you choose to live off of the money, but that's really a massive pro of using the pension. So use these tax efficient accounts and keep more money in your pocket. Fees matter. Another way to keep more money in your pocket. Fees really matter, especially over the long term when compounded. Now, a further marginal fee reduction of 0.1% might not add much if you're already paying rock bottom fees. But through speaking to people one-on-one and running my own 4-week investing crash courses, I see people who literally save 1% in fees. When you compound that 1% in fees over decades, you are gonna save a fortune. I'll flash up an example here on the screen. We have the assumptions that you're going to be investing £300 a month for 30 years at 8%. You can see after that time period, you have 422K. If we then reduce that by 1% to 7% per year, the actual total pot falls by over £70,000 to £350,000. So that is really the impact of 1% in fees. If you're investing more per month, the impact's going to be even more profound. I see this most in workplace pensions. So if you can just reduce your fees, do so, and you'll have more money compounding in your pocket over the long term. Speaking of workplace pensions, most people ignore their workplace pensions, but it's often people's biggest and most important pot. It's often people's whole retirement plans, their workplace pension. If you have a defined contribution workplace pension, which is what most of them are nowadays, particularly for a normal 9 to 5 job, you need to take control of it. Get access to it. See what you're invested into. See what fees you're paying. I know from experience with my own workplace pensions, I've switched funds to both reduce my fees and increase my returns. Your workplace pension might be fine, but definitely get access to it, take ownership of it, and see if any changes need to be made. And you can, as I mentioned, switch funds, which could reduce your fees and put more money in your pocket over the long term. And another point, for me personally, I got auto-enrolled into quite a cautious fund. Had some bonds in it, for example, whereas I've got 30 years of investing until I can access this. I didn't want any bonds. So as a result, I switched from a stock bond fund to a fully 100% stock market fund, a global equity fund, and that has massively increased my returns over the last 5 years. Of course, past performance isn't a guarantee, as we already said, of future returns, but just take ownership of your workplace pension. It probably is your most important investment account, and that's why I see a lot of people going wrong. And one more thing on this, if you have a workplace pension, it's your money and it is being invested. So please take ownership of it. And if you've got any questions, just let me know. I said 10, but here's one more bonus investment lesson I've learned, and it could be the most important one. Compound interest. You've heard it before, but time is your best friend when it comes to investing. And as everyone says, just look at Warren Buffett's wealth. Most of it was made after he was a pensioner. Getting rich quick is very hard. You essentially either need to make a business and sell it, inherit a load of money, or sell some spicy content, if you know what I mean. Be an accountant. But getting rich slowly is genuinely very easy. As we showed through previous compounding examples, even 100 quid a month can go a long way when compounded over a normal 40-year working life. I'll flash up another example of a compound interest calculation on the screen, but here you can see we start with a lump sum, we invest £300 per month at 8% per year, and you can see over 10 years, and then 20 years, and then 30 years, and finally 40 years, how exponentially your wealth can grow. And after 40 years of investing £300 per month, starting with a £1,000 lump sum at 8% per year, we've nearly got to £1 million. So that really is the impact of compound interest. Time plus compound interest equals long-term wealth. I hope that's helpful. Please drop your most important investment lessons as well in the comments down below. Before I let you go, one more thing. I will also be running another one of my 4-week investment crash courses from January 2026. I'll flash up some details on the screen. I've had some amazing past feedback. If you want to get involved, I'll leave the link down below to sign up to the waitlist, and I'll be in touch with more details in a few weeks. And if you're still here, you clearly love personal finance and investing, so I'll link another video here that you might find helpful and will be worth watching next. Thanks again for watching. I'll see you in the next one.